Hi, I'm James Robinson, and this is my stock pick of the week. This week we're going to be talking about Paccar, symbol PCAR, and we're going to work on its balance sheet. In the past, I've called this section the debt, but I've decided that I'm going to incorporate the good and the bad into the company's balance sheet. And so we'll go a little bit longer and talk about everything going on in the balance sheet or the important things going on in the company's balance sheet. So next we're going to look at cash and marketable securities. So this is how much money the company has in the bank to do whatever they will with. And you'll see that this is just, it looks great for this company. It's kind of gone up steadily over time. And when we look at the dividends, you'll see that in addition to that, the company's been paying dividends, they've been buying back stock. So cash and marketable securities for this company, it seems to me like it's very, very healthy. So here you can see cash and marketable securities juxtaposed against debt, total debt. And when I say total debt, I mean total long-term debt. You can see that the cash has gone up gradually, but you'll also see the debt has gone up more, less gradually, it's gone up more quickly. Normally that would be a problem for you and be a reason not to invest in a company. But with this company, I do know that what they're doing with this debt is they're not using it to fund the operations to build trucks. They are using it to finance people's acquisition of trucks. And so in effect, they're borrowing money at a very, very low rate because they're a very high rated company in terms of credit rating. And they're loaning it out at a slightly higher rate to smaller companies without the same ability to borrow money. And so they actually are using this debt as it's almost a profit center. In fact, in some years it has been a profit center. But at the very least, it's offsetting more than the debt and it's increasing sales because there's a wider people who can buy their products. So total debt's not a problem here. And again, we've already talked about cash and marketable securities. The big thing for me that I care about with debt is interest expense, right? Interest expense is money that you have to pay whether you have it or not. It's the kind of thing that if you don't pay it, you can get your company foreclosed on or bankrupted. And so I really do look closely at the interest expense. And you can see in this company, the interest expense is pretty close to zero. It's actually a pretty interesting chart. You can see here that in 2005, the interest income went up dramatically and was up dramatically through 2011 when it went back down. And then it's been pretty flat ever since. So let me walk you through what really happened here. The company was self-financing a lot of their sales, in part because money was very hard to come by, because the economy was in so much trouble. And that created, and they were able to charge more interest than they were paying on the money they were borrowing, and that created this nice profit center. Over time, the ability for companies to get money other than through Paccar has increased as the economy has recovered. They've reduced the amount of debt that they've been carrying, which means they've reduced the amount of spread they've been getting, to the point where the interest expense and the interest income tend to balance out. And so when you look at net interest, you can see that it's net interest, by the way, is a positive in this case, and interest expense is a negative. So you can see that this company actually has done a fantastic job, the CFO, of handling that situation. You can see that the interest expense was a positive. Again, interest expense is typically is an amount of money that you pay out. And so when you see a negative number in this slide, interest expense over operating income, it was a positive because there was no expense. There was actually an income. I hope that makes sense. So here's the company's current liabilities versus total long-term debt. We've already talked about the total long-term debt and why it is what it is and where it's going, and that none of this debt is used for operations. It's all used for financing of their cars. Total current liabilities have been actually pretty dramatically flat considering how much the income has gone up over time. So that's an indication that the company is doing a really, really good job of managing their costs, that the CFO is doing a great job of managing the company, and that the debt they're using very, very efficiently. So again, I don't very often say a company with $6 billion in debt is a great company, is a very well-run company, is a strong company. But in this case, I think this data starts to point out that that's in fact the case. So we're going to talk about interest coverage ratio in the next slide, but I want to go over what that is, what it means, and how it's calculated. So the interest coverage ratio is a measure of a company's ability to make its interest payments. So the higher the interest coverage ratio, the healthier a company is. The interest coverage ratio is equal to the earnings before interest and taxes for some given time period. Usually it's for 1 year. And then we divide that interest expense for the same period. So the interest coverage ratio is a measure of the number of times a company can make the interest payments on its debt with its EBIT, earnings before interest and taxes. It determines how easily a company can pay interest expenses on outstanding debt. So you can see there's the equation. So long story short, this is a measure of how much money does the company have relative to its debt obligation. And whenever I see a company with debt, I like to look at this number to find out just how safe they are. So again, for a company with $6 billion in debt, we look at this interest coverage ratio, and it's My minimum interest coverage ratio, I think, is 1.5. This company at its lowest point was probably 8 or 9 and is currently over 50. So it's got all the money in the world it needs to pay its interest for a very, very long period of time into the future. The interest for this company, even though it's a relatively big number, in the scheme of things is really irrelevant. This company is rock solid. It may as well have no debt. The next thing that I like to look at is years income to pay off long-term debt. I like to see a minimum, the goal, a great company would have less than 3 years of income to pay off its debt. I would look at a company and consider it if it had, no more than 10 years to pay off its debt. You can see this company has really bounced around sort of the 3-year mark over time. And again, I know that it's artificially high because they're using that money. They're effectively borrowing money that they're then loaning right back out to people at a higher interest rate. And in the exchange, they get to sell the trucks at a profit. So I'm okay with the debt level for this company. I'm okay with the balance sheet of this company. I think it's very, very strong. And it's one of the reasons why I'm advising you to buy this company.